welcome everyone to the second part of our series. It's really exciting to bring this information to you because it's the information we're going to bring you tonight is all about the indexes, and it's one of the best markets for if you're a beginner's futures trader or even an experienced futures trader. It's one of the best products that you can trade in the futures markets. And we've got our special guest from the CME Group over in Singapore, Minah Kim, who will be coming in and presenting to us about the micro E-mini futures specifically, but we're going to be looking at the other E-mini products as well, which is going to be very exciting. Now, my name is Cameron Buchanan. I'm the host for this evening, and I'm representative of the International Day Trading Academy. This is the topic for tonight. So it's Chicago Mercantile. We're going to be talking about the micro E-mini futures contracts, and we're going to be going through the fundamentals of the micro E-mini futures. And we're going to be doing lots of great in-depth discussion about the products. For those people who've maybe traded the product for quite some time, you might already know a lot about the product. But for some of the other newer traders, may not know anything about it. And then there may be some people who may be trading other type of products and maybe here for their first time. This might be a really good opportunity to find out about the product and to see what it's all about, to see if it's something that you could manage and be a part of your trading portfolio. So we're going to explain why we trade the futures and why we trade the index futures specifically. Minah is going to talk about, from the CME perspective, all about the equity index futures. She's going to explain the role in the financial markets and really give you the nitty-gritty about the futures markets and the indexes primarily. And as I said, tonight's focus is primarily on the E-mini futures. I'm going to come in at the end. I'm going to talk about the market specifications so you're aware of the numbers around the markets and what it takes to be able to trade those particular products. And I'm going to go through a little bit of analysis, more of a medium-term, medium, short-term analysis, and also we're going to do a Q&A session as well. Now, before we go into it, I do have to run through our compliance slides, and we are from the International Day Trading Academy, and we are authorised by Beyond Capital Asset Management, and our Australian Financial Services licence number is 484045, and we are licensed to be able to teach people how to trade the futures markets. Now, I do have to let you know that by trading futures, we do use margin, and this means we're basically borrowing money from a broker or a clearinghouse to be able to trade a position size that is a lot larger than what we have in our trading accounts. And I'll explain that for any of the newcomers, what that means when we get into the numbers. Now, margin does have the effect of, it allows you to trade a larger position size. However, it does have the potential effect of magnifying any profit or any loss made on the trades. And that's why it's termed high level of risk to describe futures trading. Now, with the margin, there is obviously leverage involved, and we'll talk about the leverage numbers, the multiplying factors involved in the markets. And there are two risks in trading. You have the risk of gaining money every time you take a trade. These are called winning trades. You also have the risk of losing money every time you take a trade. These are called losing trades. And finally, tonight's information is general information only. So neither your personal objectives or financial situation or needs have been taken into consideration, and you should consider how appropriate this advice is to those objectives, financial situation, and need before acting on any advice. And any past performance of this product should not be taken as an indication of future performance. Caution should be exercised in assessing past performance. This product, like a lot of financial products, is subject to market forces and unpredictable events. Now, a little bit about myself. For those people who are here for the first time, for any of the members, you know me well. But for those people who don't know me, I'm an educator with the International Day Trading Academy, so I provide mentoring and coaching. I'm a qualified teacher, and I have an extensive history in trading the futures markets, also share trading. I'm passionate about researching the market cycles, forecasting, risk management. I'm passionate also about the science of peak performance. And I also do write for the Trading Edge magazine. Now, a little bit about IDTA and why we're qualified to be able to deliver this presentation tonight is that we have members, traders that trade our system and that we educate in 21 countries around the world. We specialize in the futures markets for a number of factors, but we find they are the best markets to trade our style of trading, which is day trading methodology. We provide educators, professional traders, coaches, mentors. We also have proprietary trading systems and indicators. We have various trading rooms, coaching rooms. We trade the US sessions, the European sessions, also the Asian sessions. We have trading hub groups, and basically our lifestyle is really, or our mission is really to teach people how to trade so they can live life on their own terms. Now, what are the benefits of trading the equity index futures? And I'll go through some basic benefits before we get into the real specific quantitative reasons. But some of the most important factors is that these markets are suitable for long-term traders, short-term traders. You'll also notice that one of the news announcements when they go to the financial news on a daily basis, they'll talk about the US futures. How was the US, what was the S&P, what did the S&P do overnight? So it's a world benchmark of really how strong the US stock market is performing, or the economy is performing. So it's a major benchmark, and we see it every day, consciously or unconsciously. Now, it does suit all different types of traders: day traders, swing traders, longer term traders. And the great thing is that you can trade these markets long and short, which means you can trade up or you can trade down. And that's been a real advantage when during the COVID crash in March, we saw a lot of traders resorting to the equity index futures for a position and to trade in those markets. And we saw enormous volumes in that time. Some of the volumes were up around about 5 million contracts traded per day, 4 to 5 million contracts traded. So it's an enormous amount of volume. And it's a great place to gain exposure to the largest stock markets in the globe. It's also an exposure to the largest companies in the largest economy in the world. So you may have heard of the companies like Facebook, Amazon, Netflix, Nvidia, Google, Tesla. These companies are represented on these US indexes. So if you want to follow the overall performance of the US stock market, you can look to trade in these markets or follow these indexes. It's also a great place for traders or people that hold large stock portfolios to actually hedge in times of recession. So that means they can potentially short the market when the market's falling, and it gives them lots of benefits for taxation reasons or portfolio management reasons, that they don't have to necessarily sell a lot of their stock. However, they can go and trade in these futures markets to hedge any losses that they may incur in their stock portfolios. Also, a great thing about these equity index futures is that you can trade them 22 hours per day, pretty much. There is an hour where the market goes into a quiet zone where we get a settlement period, and then there's a period after that where the market is just slowly ticking away, and then it breaks for an hour. But the great thing is you get your weekends off, and these are by far the most popular markets for our traders in our community to trade. And the last point I'll make is that by trading these futures markets, you do have the ability to trade direct via the exchange, which is great for transparency. You know, Chicago Mercantile Exchange has been around for many years, hundreds of years, highly regulated, and it's very well respected. So it's a place of high regulation, and you'll get excellent price transparency by going directly through the exchange. Now, I'm just going to see if Minah has come in. Bear with me one moment, guys. I'm just going through the names. Not too sure what's happening there. But guys, what I might do is I might continue my part of the presentation, because what I was going to do is hand over to Minah, and but I think she's having issues connecting or coming in. So that's okay.
Cam, this is Rachel here. I think Minah's here. Minah, can you try to speak and see if we can hear you?
Yeah.
Hello.
Okay. Oh,
Hi.
me. How you going?
Hi. How are you, Cam?
Good. Welcome.
Thank you.
Minah, would you like to give us a little bit of a background about what you do? You know, how you got involved with the CME Group and the futures markets?
Sure. Everyone, good evening, and very nice meet you today and speaking to you. My name is Minah Kim. I look after equity index futures and options at CME, including the alternative investment asset classes, which is represented by Bitcoin futures and options. So it's very pleasant to speak to you today, and I'm very honored for this opportunity to present our CME listed equity index futures to you today. So glad to speak to you, and thank you very much for joining this session today. So
Minah,
let me go
great.
through
Thank you
the
for to come
CME
on.
Group's micro E-mini futures today. So what I'm going to present to you today is about the very benchmark of US equity index products. So we do have 4 equity index products, so-called S&P 500, Dow 30, and NASDAQ, and Russell 2000. And those are 4 that is represented representing the US equity index complex. And today I'm going to introduce to you that the micro size E-mini futures based on those 4 indices. So going through that, so let me briefly let you introduce what are the equity index products that CME offers. So CME has almost 2 centuries, almost 180 years of history, and through that 2 century century-wide history, we have built up this equity index product suite. Including starting from the US equity index products, and we stretch it out to all the different sub indices included in this 4 benchmark products, and also then we expanded to the international indices, including Nikkei topics and IBOVESPA, and also some of the FTSE products. And then very recently we have launched the Bitcoin futures and options as well. So and then we also have the commodity index products, which actually covers the broad base of commodity products to represent as a index format. Today, out of these many different products, I'm going to focusing on the very the key and core products, which is represented by S&P 500, NASDAQ 100, and Dow and Russell 2000. So when you talk about US equity index products, people usually talk about these 4. And you might wonder that what is the difference between these indices and what does equity index means? Because you can hear that from the media, from TV or radio, overnight US market moved up this much, or it was down this many percentage. And like, they kind of refer to S&P 500 or sometimes NASDAQ, sometimes they call Dow. Like, if you actually get a little bit better idea of what these individual indexes like represent, probably like, it will help you to determine what index futures that you want to invest in to like, gain the maximum exposure and to like, make a really efficient decision to trade like, US equity index futures. So going from like, the very first one, so let me introduce you like S&P 500. Probably by far, it is the best known index in the world. And it's actually true because more than 11.2 trillion $2 trillion of like, assets are indexed or benchmarked to this S&P 500 index. So as the name represents, this is actually like, this contains like 500 leading companies in the United States. And this index is owned by S&P Dow Jones Indices, which I put in the like, middle of this page, S&P Dow Jones Indices, a division of S&P Global. That is the company owning this index. And they have been calculating this indices starting from 1957. And this is the first United States market cap weighted stock market index. So what is the market cap weighted stock market index? So market cap is that how you calculate the market cap. You have to like, multiply the individual price of the stock, like multiply by the sorry, like there's an interruption. Do you hear me?
You're good, Minah. I can hear you.
Oh yeah. Sorry.
That's okay.
Yeah.
You were just
So
talking
like
about market capitalization.
Yeah, so the market cap is calculated by the stock, so the number of stocks you multiply by the price of the stock. So like if let's say that let's make an assumption. If Apple has like, it's currently at $124. So let's say that $124 Apple stock has like, 10 stocks they issued. So they have like, many like, stocks issued in the market, but let's assume that they have 10 stocks issued. Then the market cap of Apple will be 1240, like, $240. So that is the market cap. So based on this market cap, like this S&P Dow Jones, they calculate all the different stocks using their available stock, the number of stocks, and also the stock prices, and they kind of like, decide the index, the weightings within the index. So that's how they actually populate the 500 stocks within their index and calculate every day, every other second. So it's actually a real-time index, and also they calculate every day for the day, like the closing value, and as well as the opening value. So this actually covers approximately 80% of the available market capitalization of US market. And by now, as like, you're well aware, it's the best single gauge of large cap US equities. Something that like, I put like, a little bit of to help you a little more kind of like understand about this index. I put some of the logos of the companies here. You can actually see all those kind of familiar like, company logos: Apple, Microsoft, Google, Amazon, but also it has like Visa, Walmart, or Procter and Gamble. All the different industry like, stocks are like included in this 500 stocks. And because of that, S&P 500, they actually also calculate the sectors. So the S&P 500 is divided by like, split into the 11 sectors following the global industry like, classification standard. So each like sectors represent like, the different group of stocks. For example, they have a information technology sector or energy sector representing energy companies. So sometimes people like, you might hear from people that, oh, I do like, sector rotation strategies. Like, I try to like, invest in financial stocks, but I want to strip out like some energy stocks because they are not performing well. Those can be represented by those 11 sectors. So this is the S&P 500, the global benchmark, so-called, and now we have like, the S&P 500 futures based on these this underlying index. So the second one I would like to introduce you is about Nasdaq 100. So probably this is the hot theme in the market this year, because if you have heard about all the tech stocks, they are kind of outperforming other stocks this year. And because of that, Nasdaq 100 has been really, really outperforming this year against other stock indices like S&P or Dow. By now, year to date, Nasdaq 100 has been the gained about more than 27-8% from early this year. Compared S&P about 10% and Dow probably about 2-3% by now. So it's probably the most outperforming index this year so far. This one is the index itself is owned by a different company called Nasdaq. So you can see the company logo under the top right here, right? So Nasdaq is calculating this index, and this is created in 1985. And the big probably one of the biggest difference between Nasdaq and S&P 500 is that Nasdaq doesn't have any financial companies. So it's consisted of non-financial companies. And also another different aspect is that they also include international companies. So S&P 500 is only for the US companies incorporated in the US, whilst NASDAQ, it includes both domestic and international companies and incorporated outside of the US. So currently there are 9 companies, including Baidu or Trip.com, included in the NASDAQ. And also, as you can imagine, probably you have heard a lot about Nasdaq from the media. Nasdaq is so-called we call it as a tech stock. When we talk tech stock index, so when you talk about tech heavy index, it's always kind of we refer to Nasdaq because they have such a big weightings in the technology stocks. You can see from the company logos here that these are the top 10 weightings within the index within 100 stocks, not only Apple, Microsoft, Amazon, Google, but you can actually see Tesla and PayPal, Netflix, all those kind of familiar tech stocks are included in Nasdaq. And it actually it has more than 50% within 100 stocks. This is also market cap weighted index. A little bit kind of difference is a modified market cap weighted index. Each individual index providers have their own methodology to calculate the index, and they kind of adopted a modified market cap weighted methodology, meaning that they only count on the tradable stocks in the market. So they kind of excluded those stocks not offered in the market, which is kind of just maintained within the firm, or those kind of stocks are not calculated. So that's kind of, we call it modified market cap weighted index. And top 10 constituents, which I put as the company logos on the left side, they represent make up about 55% of total weight. So compared to S&P, Nasdaq, it's very kind of, you can see actually a heavy concentration in the large cap stocks as well. Nasdaq, they always try to be very innovative, and you can probably find some stocks which are not included in S&P, such as Starbucks, or some of the very innovative biochem companies who are working on those coronavirus vaccines. Those pharmaceutical companies are all included in Nasdaq 100 index. And then we go for Dow. So Dow is, so it's, the abbreviation is DJIA. It's a Dow Jones Industrial Average Index, and it's one of the world's oldest stock market indices. It's created back in 1896, super old. And because of that, this name has kind of legacy industrial average in the name, because well, when the index was created back in 1896, most of the index components were railway companies. So because of that, it has a name as a Dow Jones Industrial Average. But for now, it's more of an indicator of general health of U.S. economy. Why we say that? Because like the index provider is actually the same as S&P 500. They got merged, so now S&P Dow Jones is calculating this Dow index, but they wanted to pick up really 30 blue chip stocks which can well represent like United States. So they have a committee, so it's not only about like kind of like the calculation methodologies that they actually like pick up to they kind of like use to pick up the stocks within like this Dow Jones like index component, but also they kind of review and like kind of all those kind of different aspects of the company, like review the reputation as well, whether that can really well represent like America. So you can like imagine that we say that this is 30 US blue chip companies, but also it's kind of very carefully selected 30 stocks. And because of that, and because of this history, like there are certain countries, especially in Asia, if you go to like Taiwan or Southeast Asia, the media always highlight the Dow index. Like when you actually turn on the TV in the morning, when like for example, in Australia, the media will say that, oh yeah, like S&P 500 was like closed at which level overnight, and it was up or down. But if you go to some like Southeast Asia countries like Malaysia or Taiwan, like they actually refer this Dow as the indicator of U.S. stock equity index. So like if you turn on the TV, they feature Dow index, not the S&P 500. So the company logo, you will probably like find it's the kind of like all the kind of very familiar American company names here in 30 stocks. Like all those are Coca-Cola, McDonald's, and even for the financial companies, it's Goldman Sachs or Bank of America and the Boeing. And American Express. So like you can imagine, and Walt Disney. It's like those very representative like US companies are included in this Dow Jones. So the last one is about like FTSE Russell 2000. Probably like people are less familiar with this one compared to the other three. This is the underlying index of our micro mini Russell 2000 futures, and what this represents is that, as the name says, it represents 2,000 stocks, the small cap stocks in the U.S. So the index calculator is FTSE Russell, this kind of round shaped logo, which I put on the middle of this slide sheet. So FTSE Russell calculates this Russell 2000 index. They have their own methodologies, and like the Russell like have Russell 3000, which actually covers 98% of the investable US stocks market. And out of 3000, they kind of like set up the block. So 3000 is the umbrella, and like among that, the Russell 1000 is a representative of large caps, and then the rest like 2000 from the bottom are Russell 2000 representing the small cap. But you know that the reality is reality. This large caps are represented more by like S&P 500 or Nasdaq 100. So people are for the Russell calculated index. It's the most well-known index is the small cap index called Russell 2000. And even though the number of stocks included this in the index is like very many, like 2,000, in terms of the market cap, it's only like 10% of total market cap. So it's only about 2.5 billion, quite small. Like a lot of the like companies, even like if you actually pull out the top 10 constituent of this Russell 2000 index, you probably have never heard of those like company names. It's a very small companies and 2000s stocks, which actually consist of this FTSE Russell 2000 index. But still, like in terms of the AUM, asset under management, the funds, like globally the ETFs and the funds, mutual funds, tracking this Russell 2000 is not negligible, because this is kind of like the benchmark for the small caps. So if you want to have an exposure to the small cap, this is kind of the easiest way to have an exposure. So the funds tracking Russell 2000 is currently like $1.7 trillion, and the active funds are about like $1.4 trillion. So as I said, that top 10 constituents, I wanted to put that like top 10 constituents in this slide, but even I have recognized that I'm not really familiar with even those 10 constituents because they are such a small companies in the US. So I would rather just show you it's only like 4% of the total weight. So meaning that this Russell index is very much diversified. And probably a very best way for you to carry an exposure to the small cap, because like if you think about like when the market is actually going down, like the small caps stocks are hit like harder than the large caps. But also when the market is rebounding, this can be actually like rebounding faster than the large caps because those kind of small cap companies, very small companies in the US, they have a very light balance sheet and very vulnerable like to the volatility. So they are like pretty much volatile compared to the large caps. So if you want to enjoy those kind of like volatilities from the small cap companies, this is the index that you have to consider. So these are the four main equity index indices, which is supporting our equity index futures, and which is based which are the underlying indices of our micro E-mini futures. So the micro E-mini futures are constructed based on these four representative US equity indices. And I'm going to share a little bit about how it has kind of historically and what we have built up in this market and how this micro futures is performing since the launch about a year and a half ago. So you can see from this slide, when the stock index futures were first launched many decades ago, uh, even there was probably no computer, and everything was kind of traded on the floor, as you can actually see on the crowd on the top right of the picture. That's still that pit floor still exists in Chicago, on our headquarter office. And nowadays, because everything has been transformed to electronically, and as you can just very easily trade from home, these floor has just become very empty, and now it's more of a kind of heritage place. But still, there are a couple products we are running on the floor. So to show you the history of equity index futures and CME Group, so we have gone through 3 generations of US benchmark equity index products. So the very first one, standard S&P 500 index futures, was launched back in 1982. And the first day volume was a little less than 4,000 contracts. And then after this, we launched standard mid-cap 400 and Russell 2000 back then. When we launched this first stock equity index futures, the S&P 500 was, you can see the price graph here. It was really probably lower than 250. Can you imagine that? Because nowadays the S&P 500 index level is almost close to 3,500. And as the time goes by, after about 15 years later, in 1997, we launched the E-mini S&P 500 futures. The reason why is that because the index level has jumped over to 1,000 level. So still compared to nowadays, it's quite small. It's only 30% of where we are. But back in 1997, it was a big jump compared to 1982, meaning that the people have to pay more margins and to pay more dollars to trade this S&P 500 futures. So we had to introduce this mini size S&P 500. And also this is a time when we actually started to introduce electronically trading platforms. So that's how we actually put the E-mini, which is kind of just now so popular. You can trade everywhere, from desktop or mobile or your iPad. But back then it was not that popular. So that was kind of why we actually put this E-mini E under our name. So 1997 was kind of also a historical moment for us, introducing this E-mini S&P 500 futures, which is by now the most trade in terms of the liquidity, the most liquid product, the most liquid exchange traded futures product in the world, because it trades more than 2 million contracts per day, around the clock, 24 hours. And then we kind of maintain this E-mini S&P 500 as our benchmark signature product for over 2 decades. And then we decided to introduce micro E-mini futures in the market. We just launched this in May last year. And the reason is you can actually imagine from this graph, when we launched the E-mini S&P 500, the index level was just around 1,000. And last year it started to hit 3,000. And people were mourning because think about how much of money you have to pay to buy one contract of futures, because the index level has jumped up 3 times from the time that we introduced e-minis, meaning that your margin level and everything, all the costs has also escalated to 3 times. And that actually made a lot of the people in the market staying away from S&P 500, even though everyone is aware that this is kind of benchmark of the global economy. So because of that, we wanted to provide a more access, easier access to the people, especially to the individual traders. We launched this micro E-mini futures last year and sliced the contract size to 1/10. So the contract size, which I'm going to talk a little bit more about in the next few slides, of micro E-mini futures are 1/10 of E-mini futures. And it was massively adopted and welcomed by the market. You can see from the first day volume, 310,000 contracts traded on day one. And this is by now over 180 years of CME history, the most successful futures contract that we launched on the CME. So talking about this micro, so we kind of sliced the contract size by 1/10. What that means, we didn't touch anything else, only the contract size. So because of the contract size, it's just a small size, but you actually you can enjoy all the different aspects of trading E-mini S&P 500 by using this micros. Just smaller contract size and smaller amount of money that you can put in as a margin, but other benefits, key things, you can enjoy the same benefit, exactly the same as what some institutions are trading with the E-mini S&P 500. So it gives you a lot more flexibility, and from your perspective, probably probably the easiest way to implement long and short view, with a small amount of margin. And also this can be a leverage opportunity as well, because for all the equity index products, equity index futures and CME, usually the margin rate is around 5 to 10% of the notional. So meaning that you can enjoy the leverage of as much as the 10x, and because of the small contract size, this probably give you the best opportunity to gain the exposure to the US equity index with a very small amount of margin in your pocket. So the contract size has decreased, but we have to understand that what that really means. Does that mean that you will enjoy the same gains and risk in terms of the dollar amount? So I I put a little graph here, little table here to make you better understand about what is the actual differences. So this is an assumption. I put the entry price and exit price of S&P 500 index. So let's assume that you enter into, so you bought one contract of the futures of each the standard size, E-mini size, and micro E-mini size at 3,300. And let's say that you try to sell at 3,475, 3,475. So the difference between these three contracts, as I mentioned, is a contract size, and how that is achieved, it's because of the multiplier. So the same index level at 3,300, to calculate the notional value of this the one contract of the futures, so what you're holding, you have to multiply by this multiplier to get the correct contract size. So let's say the standard size, the very kind of like, you know, legacy standard S&P 500 futures, if you buy one contract at 3,300 index level, and then you multiply by $250, meaning that you carry a notional value of $825,000. That was kind of brought down to 1/5, like for with the E-minis, because the contract size is 1/5 of standard size. So meaning that if you buy one lot of futures at 3,300, you multiply by $50, that is the contract size, then the notional value you carry at the initial trade is 165,000. And the same for the micro E-minis, because this is like 1/10 size of the E-mini, meaning that the multiplier is only $5. So if you buy one lot of micro E-mini S&P 5 futures at 3,300, it becomes like, you know, the notional value of $16,500. So what that means, it actually affects your initial margin, because initial margin is calculated as a percentage term from your notional value. So let's say that as of like, you know, this is actually something that I pulled out yesterday, because the margin always changes, because this is the risk measure from the exchange perspective. So you always have to like, you know, make sure that you check the correct like margin level with your brokers and the exchange. So yes, as of yesterday, the initial margin of standard S&P 500 futures was about 66,000, whilst like, you know, E-mini S&P 500 was 13,200. And micro E-minis, because it's a 1/10, you can actually see that it's like even less than like $1,500. So this is the dollar amount that you have to pay to the broker to buy one lot of the futures contract. And so that actually explains you that what this like, you know, difference in the contract size means, that meaning that it actually decreases your initial margin. But then like, you know, let's check about like, you know, what this means in terms of the risks and like, you know, gains. So I assume that like, you know, your risk level is 30 points. You can only tolerate like, you know, 30 points index decrease from 3,300. Then like, you know, this 30 points in dollar term, if you convert it to the dollar, so meaning that 30 points multiplied by the contract size, $250, becomes becomes like $7,500. And also in the same way, if you actually multiply by the contract size, for example, like the micros, the same 30-point index drop, the risk in dollar is 30 points multiplied by $5, so 150. So it seems like you are exposed to like, you know, smaller risk, but also in terms of the gain, because you are investing smaller amount of money, the gain in dollars also comes out smaller amounts. You can see like, you know, because your entry price was at 3,300 and your exit price is 3,475, the gain in points is 175 points. And if you actually multiply this by like the contract size, you can see the like gain in dollars difference here. So the E-minis and standards, as much as like, you know, it's expensive, the gain in dollars is also larger, but also you can like, you know, enjoy the gain in dollars, $875 by buying the one micro E-minis, which you wouldn't have like had if you were not to like, you know, buy E-minis, which is quite expensive, right? So this is something that the opportunity that you can have with this micro E-mini futures. So having said that, let me talk about like a little bit more about the margin, because this is the investment, like, you know, the money that you have to consider when you actually enter into the trade. So these, like, you know, on the top left is MES, MNQ, MY, MYM, and M2Ks are the product codes of the micro E-mini futures. And imagine that the current like futures price is like here. This is something that I pulled out from yesterday. And these are the multipliers, the preset multiplier of each contract. So this actually indicates the contract size. So if you actually multiply the futures price by this multiplier, that actually drives the notional value of each contract to invest in like one lot. And then like, you actually pull out the initial margin from there and also the maintenance margin from there. These are always, you can actually check on the CME webpage, and also you can check with your broker. I'm not gonna like, touch into the very details, but you can actually see like, what is the percentage of your initial margin and maintenance margin, which is like, currently a little higher because this year the market has been a little volatile. So if the market is a little volatile, the risk like, factor goes up. So the margin ratio goes a little up, but still like it's quite manageable, around like 6 to 8% of the notional value that you are exposed. Meaning that with only like this 6 to 8% of the notional value, you can actually carry the same exposure to the index itself. So here, like, a couple more information, like to support the screen liquidity, CME Group, we always kind of like, have the market makers supporting the market around the clock. So you won't find any kind of like, bid and offer gap in between, like, when you actually try to like, trade buy or sell and on the screen. And also another thing is that as I said, like this micro E-mini futures is something that the kind of like, we call it third generation of our E-mini like on our like, equity index futures complex. Like, so we actually introduced the E-minis about 2 decades ago, and this is kind of like, the micro E-minis derived from this E-mini contract. So these two are actually fungible. We not only we sliced the contract size to 1/10, but we made it fungible. So if let's say that if you have like, if you buy 10 lots of micro E-mini S&P 5 futures, and let's say that you have shorted, you sold 1 lot of E-mini S&P 500 futures, then the position can be collapsed at a different, so it has to be different direction, but 10/1 ratio. So you can always ask your FCM, so whether you can actually collapse your positions so that it can net it out. And you can also find the price quotes from your broker or like, your trading platform, or even the CME Group website. We actually provide a delayed quotes. So there are like, a lot of things that you have to consider, like, when you trade like equity index futures, like probably like, execution costs, liquidity of the product, and also whether you can have an access around the clock, like from the time that you wake up till you go to bed, or like, if the technical indicators are available, which is used for like stock market or ETF market, yes. And like also, let's say that then like, why should I trade like, this one? Like, you have an access to the stock market and ETF market. So let me briefly talk about like, what is going to be like, beneficial to you by trading this equity index futures versus some of the popular ETFs or like, just the cash stock. So equity index futures is very highly capital efficient because, as I like mentioned, like previously, you only need to prepare like less than 10% of the notional that you're exposed to as a margin. So you can leverage out about 10x or even more to trade this equity index futures. And as I mentioned, that this is probably the most liquid product in the world in terms of like derivatives product, and also very transparent because everything is traded on screen, and you have kind of like very immediate access to the margin. You can always check like where is your margin level with your broker, and also like it's a 24-hour access. And the electronic market, cheap beta means that the beta is kind of like measure of the volatility. So the index actually represents a one, like in terms of the beta. So if you actually trade index futures, meaning that you will always be like following the beta. You don't like need to worry about like underperforming compared to the index. But also you have to, what you have to consider is, for example, like every quarter, all those U.S. equity indices, you have to roll your positions to the next quarter. So for now, you are trading like December contract of futures, and then like probably like in the middle of December when the contract expires, you need to actually roll this over to March. And that is something that you always have to keep in mind and always have to communicate with your broker as well. And this, you have to have a separate futures account. Even though you're trading like US stocks, you cannot actually trade this in a securities account. And it's always not always block eligible. Yep. Think about cash stocks. So when you actually want to invest in the US cash stocks, such as let's say Netflix or Apple, yeah, probably you might feel that, oh, it's probably the best way to invest in, but think about the money you have to put in. You have to pay the full amount of notional to get this exposure, buy the one stock of Apple. You have to have $124, not $10, to carry one stock of Apple. And this is not classified as derivatives. And probably if you obtain certain amount of stocks, you have the voting rights. But that means that you get the dividends from the cash stocks, but also that actually gives you a little bit of trouble, because we are all we are all living outside of the U.S. So as a non-U.S. citizen and as a foreign investor, you'll probably need to handle with a withholding tax from the dividends. So that's kind of also a troublesome. And also, let's say that you picked a couple of stocks that you feel that it's going to outperform every other benchmark index or others, but you never know. Your stocks can outperform, but your stocks can also underperform what the benchmark index, broader index, is performing. Let's imagine that the S&P 500, or even talk about Nasdaq 100, year to date it has gained about 30%, but what if your stock, what you picked up, is gained about 10% year to date? Then you're underperforming. So you're kind of managing your risk by yourself by picking up the cash stocks. And for the ETFs, yes, this is quite easy and accessible product for the individual traders as well. But let me point this out. The fees to trade the ETF is much more expensive, because this is something that you are buying the ETF, meaning that there's a the ETF manager, portfolio managers, and the fund managers there, they actually manage this ETF fund. So you have to actually pay the management fee. And also, because this is consists of stock baskets, it's kind of difficult to short. Whilst index futures, if you feel that the market is actually collapsing, you can just easily short. And of course, higher margin ETFs, even though there's kind of regulation, it's called the regulation T, you have to pay at least more than 50% of the margin of the notional you carry, meaning that it can be quite expensive to carry the exposure using the ETFs. And of course, that the dividend withholding tax exists for this ETF because it consists of the stocks. And apart from all those different advantages and disadvantages that I showed you, let me tell you what, this is probably something that you have to consider trading the equity index futures rather than the ETFs, because the liquidity is so different. You can see here the E-mini S&P 500 futures is actually trading 10 times more than the SPY ETF. And probably if you're familiar with the QQQ, the Nasdaq 100 ETF, E-mini and Nasdaq 100 futures average daily trading value in US dollar term is 12 times more than QQQ, meaning that there's a liquidity, something that you really have to consider, because meaning it does mean that when you want to be quick and buy or sell in the market, probably the equity index futures is the best and easiest way, and probably the quickest way to express your view. You wouldn't be missing the price that you want to trade because it's super liquid around the clock. So I only compared about E-mini futures, but let me talk about a little bit more about the liquidity of micro E-mini futures, which we launched it about a year and a half ago. So you can see that we actually launched this product in May 2019, and the average daily trading volume by month, it's kind of exploded this year, because people started to learn that this is kind of very very like user friendly, and also you can actually invest in with a like cheap money, and also it's kind of easy way to short, and like you don't need to like worry about like borrowing the stocks to short when the market was collapsing back in March or April. And also when the market is recovering, you can easily like buy them. So you can actually see that it's started to explode really starting from like this year March time, and still like so many people are trading this, and the average daily trading volume is, you can see that more than 2 million contracts per day. Oh, before I move on, like, let me also talk about this. So these are across the 4 equity indexes, like, 4 micro index futures. And you can see that, like, the gray one, the micro E-mini S&P 5 futures are trading the most among the 4 different indices, and probably like followed by the Nasdaq 100 futures. Guess what? In Asia, because of like Asia people actually love the technology stocks, and because of that, if we only pull out the data for like from Asia-based customers, Nasdaq 100 micro E-mini Nasdaq 100 futures is taking about more than like 55% of the daily trading volume out of these 4 indices, and micro E-mini S&P 500 futures is probably about 35%. So MNQ, the micro E-mini Nasdaq 100 futures, is kind of like the most liquid product among like Asian investors. So like, I keep highlighting that this is 24-hour trading, almost like 23 hours to be honest. But like, you might be curious that, maybe like, a lot of them are only trading during US hours. Maybe we may not see those certain like liquidity during Asian hours. So here's the chart for you to check how it's trading around the clock. RTH is the US cash hours, and ETH is non-US hours, extended trading hours. So it's 9 a.m. to 12 a.m. Sydney, which is I think 8 a.m. to 11 p.m. Queensland. So during that ETH, it's actually like more than like 30% of the daily trading volume is traded during ETH, and you might think that 30% is small, but it's actually not, because as I mentioned, that it's trading like 2 million contracts per day, meaning that like 30% is 600,000 during non-US hours. So 600,000 of contracts are trading during like Asian hours and European hours. And to show you, because like the compared to the like E-mini size like futures, E-mini Nasdaq 100, the micro is actually more tradable and accessible. And because of that characteristics, we are seeing actually the micro size products are trading actually more than E-mini size of futures during extended trading hours, especially for Nasdaq. You can see this graph, and we can also share this like the slides after this the session. And also, like, this is the same case for the benchmark S&P 500. Like, it's like because of like a lot of institutions are actually trading the E-mini size. So like you will see that the micro is not trading more than the E-minis, or even during like non-US hours. But you can see how much the gap is kind of narrowing during non-US hours. So probably you can imagine that those kind of like dark blue lines, micros are mostly traded by the individual customers who actually want to have an like kind of express your view about the US market, whilst like the sky blue line is probably like mostly traded by the institutional investors. But as I said, the only difference is the contract size. You enjoy the same benefit by trading like the micros against the E-minis. One more thing that I want to like talk about is like how people use this like ahead of the presidential elections, which is much of like anticipated volatility. Because we are actually fast approaching to the presidential election in early November, and like I pulled out the case study from like back in 2016. And here you will see like where and which vehicle, which product that you have to trade or invest in, and to express your view about like toward the election result. you can see from back in 2016 on the election night, E-mini S&P 500 futures, because back then we didn't have a micro E-minis. So E-mini S&P 500 futures were trading about $264 billion just that night, whilst top 3 S&P 500 ETFs only traded $7. So the liquidity was kind of very much concentrating on futures, because it was something that you can actually easily really kind of invest and express your view, where this is going to go and what this election result is going to be, and how you can ride on this volatility. So this actually provided the kind of most easiest tool for you to access to express your view against your US elections. And we assume that is this going to happen again this year, because whenever there's kind of headlines related to this election, especially this month, we are seeing a lot of volume coming in micro and E-mini futures for those S&P Dow and Nasdaq. So because we have a limitation in the time, so I try to really briefly touch about our benchmark for US equity index products, but we always have cmegroup.com/education page where you can actually explore and kind of polish your skills to trade equity index products. So if you have any questions, always please feel free to reach out to your brokers or to the CME Group as well. We have our webpage, and there's just kind of small boxes that you can actually fill in if you have any questions to the CME as well. So thank you so much, and I look forward to kind of your questions. If anything I can answer today, I'm happy to answer, and if I cannot, I'm happy to reply back to you over the email as well. Cam, are you there? Back to you.
Thank you, Minah. Yes, I'm just getting my screen up and running. That was wonderful information. Thank you so much. I'm on a different computer today because my other one was playing up. So I'm on. Can everyone see the screen? Is that projecting now?
Yes, we can see your screen. Oh, yes, now we can see your screen.
Oh, brilliant. Yeah, thank you, Minah. That was wonderful information. I learned a lot from that presentation, and I'm sure a lot of our attendees got great information out of it, even if you've never heard of anything about the futures markets. To know the depth of information and the size of the actual market is enormous. Those figures you were showing in terms of just the amount of volume traded on a daily basis is just astronomical. And but even if you are an experienced trader but you've never traded futures before, it is something worthwhile having in your artillery or in your weaponry, your arsenal of trading devices, because it's like Minah showed us that the amount of volume is enormous, and the ability to get in and out of the market is very easy. I just want to show my screen as well. Make sure that's working. All right, I didn't want it to be that big. Anyway, that's all good. So what I wanted to go through now, guys, was just to reinforce a fair bit about what Minah was saying, but I just wanted to bring up some interesting points regarding the amount of weight of some of these stocks that are on the S&P 500. I did a search today on Investopedia, and you can see here that Apple owns 7.3% of the current weight, and that's, like Minah said, it's always adjusting. So their market cap is over $2 trillion worth. And you can see these names, Microsoft, Amazon, Facebook, the Google company, Berkshire Hathaway, which is run by Warren Buffett, Johnson & Johnson, Visa, Procter & Gamble. So they're the top 10 companies. And you'll notice that on the right-hand side, those 10 companies make up 30% almost of that index. So if you want to get exposure into the US stocks, these equity indexes are wonderful, especially the S&P 500, and particularly with the rise of technology, what's been called the Fangman stocks plus T, which stands for Tesla. There was interesting that recently, I don't know whether you've been following the stock market, but Tesla had a parabolic rise in its price, and the main reason why it had that big rise was that it was word that it was going to be accepted into the S&P 500 index. Now it didn't for various reasons. The committee didn't allow it in at the time, and the price dropped 20%. Tesla's value dropped 20% when the announcement came out. So, you know, there's a lot of hype around these indexes. Also, I just wanted to go through. Minah talked a lot about the contract sizes and the multiplying factors. And just to review that, there was the E-mini S&P 500 is the contract. So if you bought one contract, it works out to be around about 173,650. That was if it was. I'm not too sure what the price of the index would be, but that would be up around about that 3,300 mark. Also, to the trading hours, we talked about these trading hours. These are at Chicago times, but these hours are, you know, they're open for a long time. So, you know, 8 o'clock Queensland time, and they close at 7 o'clock in the morning. So you can. A lot of our traders will trade either the US closing session, or they'll stay up late and they'll trade the US open session, or they'll trade the Euro open or the Asian market. It's very interesting what you were saying, Minah, about the Asian market and how popular the micro indexes are right now, because I've seen, you know, I've been trading these markets for about 8 years now, and I've just seen incredible growth in the amount of volume during the Asian market. So if you want to trade the Asian market, it's a great time to trade the futures markets. There's so much volume, and you never get short of getting in at or out of the price that you want to get in or out at. Now the margins down there, now those margins are overnight margins. You do pay less if you're trading intraday, which means if you're getting in and out as a day trader, the margins are significantly less, because the clearinghouses or the brokers will give you discount rates. Okay, just so you're aware that the broker clearinghouse we use, when we trade the micro contracts, we're trading the margins that we require is only $50, whereas as you can see on this particular margin on the S&P 500 is 13,000. Now that would be an overnight margin that the exchange is charging, but the brokers and the clearinghouses do make it way more accessible. So we're paying around about $500 to be able to trade this particular market, the E-mini S&P 500, whereas on micro we're paying around $50 or not paying, but that's the amount of money that we need to have in our account, which is a margin, and that allows us to trade one contract. Also interesting to note too from these figures is the circuit breakers, and we saw that this year when we had the COVID collapse or the COVID crash. We saw the markets capitulate during that time, and many days in the month of March we saw that these markets would get to limit down, and this is a great protective device because the market cannot completely capitulate. They actually close the exchange when the market gets to a certain percentage. So for instance, if the market drops 7% of its price, the market closes. So there's some great protections in place that the exchange puts in place for traders as well. One of my biggest trades I made in the year was actually during a limit down scenario. So when the market falls, the market drops very quickly, and you can make significant money if you know what you're doing in these more volatile conditions. Now the micros, I'll just go back. The micros, you can see here, I won't go into too much detail here, apart from you can see the contract size is way less, obviously a tenth the size of the E-mini standard contracts. The micros are way more accessible in terms of their margin as well. You can see this is the exchange margin, is 1,300, and that would be an overnight margin or a maintenance margin, initial margin. So there, obviously, if you're trading longer term positions in the market for a lot longer, you would need to have that type of money in your account. However, if you're intraday, you're looking around about $50. Once again, you've got all the same circuit breakers, same opening and closing times, and the accessibility is brilliant. And once again, interesting too about the expiry dates. That means this is a very traditional structure, I guess, in the marketplace. They have these contract dates. Now that means the contracts do expire, so it's important to be mindful of those rollover dates, because you will need to, if you're in those positions, you will need to roll over or get out of that contract and back into the new contract, or the following contract. So just be very mindful if you are going to be trading these types of products and you haven't had experience, you do need to be mindful of expiry dates. And also just for those people that have maybe traded Forex before, are very familiar with pips, that type of terminology. When we're trading in the futures markets, we use ticks as the smallest fluctuation of price. And you can see here with these are the primary markets that we trade. Some of our traders, we used to trade the Russell. We don't trade the Russell as much anymore. However, like Minah said, it is a very good market to trade if you want to catch volatility. I was just looking at the Russell today, and the Russell's already almost back up to its all-time highs, whereas the NASDAQ and the ES are not quite there yet. They're getting there, but not quite there. So the Russell is actually leading the launch back after the COVID crash. Now the ES, which is the E-mini S&P 500, these are the codes. All right, this is what these are. If you see these here, you've got the micro E-mini S&P 500, you've got the NASDAQ 100, and then you've got the micro NASDAQ 100. Now, as you can see, the tick values are all the same. So every smallest fluctuation of price movement is 1/4 of a point. This is incorrect, guys. I'm sorry that I put 10 ticks up here. If the market moves four ticks or 4/4 points, it's actually moved 1 point, which is a four tick move. All right, now a 4-tick move on this particular market is worth $50. A 1-tick move is $12.50. All right, so you just only need a very small movement in price to make $12.50 US. You don't need to be in the market for a long time. When you look at the amount of price movement in these markets and the volatility, we're seeing, like last night, for instance, on the NASDAQ, we saw around about a 1,200 tick move on the NASDAQ. If you're wanting, say, $50 out of that market doesn't have to move very far. It only has to move around about, if you're trading the full contract, it only has to move 10 ticks. If you want to make, say $5 on a trade, it might seem like a very small amount of money, but you only have to trade the micro NASDAQ, and you only need to go for a 10-tick trade, which is a very small trade. It's only 2.5 points of movement. Just a summary of the volumes. Now, this is just on the latest contract, and these are just a 20-day average of volume on the E-mini S&P 500. We've seen that the market has traded around 1.6 million contracts on average in the last 20 days. However, we've seen times where the markets are trading up around 2 million contracts, 3 million contracts, 4 or 5 million contracts in really volatile times. Interesting to note, the micro is not far from the E-mini contract. It's catching up. The point change. This is the volatility we've seen, or the price difference has been very similar, but that's a nice amount of movement. 137 points of movement. You multiply that by 4, and then you multiply that by $12.50 or $1.50. That's going to give you the amount of money that those movements are worth. So if you've been in a trade, for 20 days, you've seen it around about 136 points in movement, which is a quite nice little return if you could catch the high and the low of that. Now, this is the interesting point here. The NASDAQ, we're looking at 580,000 contracts, whereas the micro NASDAQ, like Minah was saying, is almost double that now, running around about 800,000. So this is a great contract to trade. A lot of our traders are trading the micro NASDAQ. It's probably the most popular market. It's very accessible, and it's a good market.
Cam, let me add one more point. So, starting from March this year, we are actually seeing more volumes coming into the micro Nasdaq 100 futures compared to E-mini Nasdaq 100 futures, because probably there are more investors and individual investors who actually want to express their view through these futures. And also, one thing that I can talk about this Nasdaq 100 futures is that people really talk about, as Cam mentioned on the first page, we always talk about, nowadays talk about FANG stocks, like Facebook, Amazon, like Netflix and Google. And also there's a index called FANG index. But what we can tell is that if we actually compare the correlation between FANG index, which is comprised of those 4 or 5 tech stocks, versus Nasdaq 100 stock index, the correlation is almost 96-7%. So if you actually want to invest in the FANG stocks, it's actually a better alternative way to invest in a micro E-mini Nasdaq 100 futures.
Yeah, it's a great point. Awesome. So guys, now I'm just going to go into a little bit of forecasting before we go into a Q&A, because I just wanted to show you some of the charts and just give you some midterm predictions on what we're going to see over the next few months potentially. So there's a few technical levels that I'll talk about, and these are our support and resistance levels. So there's some Fibonacci retracement levels, some horizontal resistance that we'll look at, so mainly double tops, and there's some patterns that have been occurring as well that have given some really nice moves. I'm not going to talk too much about the diagonal resistance like trend lines or any of the dynamic support resistance. I'm just going to keep it really simple with some major price levels. So the first chart I want to look at is the S&P 500, and this is a weekly view. And if you look at that, if this big drop from 3360 down to 2200, that was the COVID crash. Right now, we can see in that month of March, we had that 5-week period, 4-week period. We had from February 20 was the high point. We had a massive rundown. So this is where you could have used the futures, the E-mini futures index products to short the market and to protect any of those losses that you may have been experiencing in your stocks. Now we had an incredible bounce back. We weren't expecting this bounce back to occur so quickly, and the S&P has broken that prior high, and it's made a high up around 3,600. Now there's some key levels on the weekly chart we want to look at, and these are for if you want to write these levels down, because these are more of a longer term view. But the first level I want you to look at is 3,600 level. Now this is going to be an interesting level because it looks like the market is in a very bullish mood right now. We can see that the market is stair-stepping, the bulls are back in town, and it looks like we're going to be retesting these highs up around 3,600. And we've seen that occur Friday afternoon, we saw that, and we've seen that occur Monday. We saw an incredibly huge run in the indexes. Now there's a few levels. If we see the market stalling up around this 3,600 area, we could potentially see a double top. And as we know, traders love looking for short positions off the double top. So if we see any type of negativity after the elections or anything untoward, we are expecting You know, from our studies of cycles, we are in what we call a mid-market slowdown. We are expecting the markets to cool off, and I think we're going to see if the market can't get back to that 3,600 or at least fail up there, we will potentially see these levels to the bottom tested. So 3,200 is a very key level on the weekly chart. And then we've got the 2,870, which is basically a 50% retracement between the 3,600 and 2,200. So there'll be the first sort of points of if the market is going to short, potentially at the end of the year, we see the market really starting to sell off. We could see these levels being tested first, right? So 3,200, 2,870, and then if we really see that it drop hard, then we may see a retest of the COVID crash. But obviously, we would need some pretty bad news for that to occur. So let's look at a bit more of a daily view. And you can see here, this is the most recent range that we've been trading in. So from the start of September, we saw the market sell off back down to this 3,200 level, which is a very strong support level in the market. And if we see that if the market does come back through these other various shorter term levels of support, the 3,200 will be one of those levels that we will need to see the market to break under before we can go short below that level. But to the upside, you can see here we have got this type of what we call an old-fashioned head and shoulders pattern. And we can see here on the Friday, which is this candle here, we can see the market break above, or the Thursday, Friday, we saw the market break above this key level of resistance here was around 3,420. So that's a very strong support level now in the market as well. So if we see the market start to fail off, we see a retest, I think we're going to see a retest of these tops up around 3,576. If the market does fail up around there, then we're probably going to see the market tend to range or bounce between these support and these resistance levels, especially coming into an election. We're going to see high volatility, and we're going to see the market, respecting potentially these key levels. So I've got these support levels marked in. I've got 3,420. I've also got 3,390, which represents the 50% of this midpoint. Also, I've got 3,300, which is like a step break level there. So that's another support level. But also these prices, I would write them down, because the part of your analysis when you're looking for the markets to the particular strong levels to look to trade from, off strong support, or short off support that's been broken, or trading short off strong resistance. These are these key levels you want to look at. So to the top, we've got 3,576, which is the all-time high. And then we've got these support levels down below if the market does want to come back through here. So in terms of a medium-term view, we're expecting high volatility with the elections coming up. Looking for longs up to 3,576, particularly if we can hold above that 61.8%, which we are at the moment. We're well above 3,430, which was a key Fibonacci retracement level that we managed to get above. And that really turned the trend. That's why we saw the NASDAQ yesterday. When it held above that 61.8, the market zoomed right up to almost the all-time highs. Hasn't quite got there yet. Now, on my longer-term view, I'm looking for shorts. I think we're going to see a bit of a sell-off in the markets once we see a retest of the high, and once all the election stuff settles down in the United States. Looking for potentially double top, triple top trades. I'm looking for shorts off those highs. But one of the trades that I love, and I tell our more experienced traders to look for their weekly charts and look for the first swing trade, all right, which is basically it's almost like a new step starting to occur, or it's like a very an aggressive way of catching a new trend. The trend may not have potentially formed yet, but it's giving you ideas that the trend is forming. So I'm going to be looking for the first swing short as a really strong level on the weekly chart. Then I've got these other levels down here. I'm going to watch for these support levels: 3420, 3390, 3330, and 3200. So they're very key price levels. I'd write them down, put them in your analysis journal. Also, too, if we get a break at 3,200, this will mean that the major uptrend we've seen for the last 10 years looks like it's breaking, and we will see a change of trend or a correction in the longer term. So that 3,200 level is very key in my mind. Now, NASDAQ, very, very similar. I've only got the daily chart here to show you, but once again, it's very much so mirroring the S&P 500. The S&P, the NASDAQ has recently, you know, if you look at the head and shoulders patterns, identical. Really, it probably was a little bit lagged in terms of the fact that it didn't break the 61.8 until yesterday, whereas on the S&P it had broken it on Thursday. But that gave you intelligence into the fact that this market was, or the NASDAQ was going to be bullish as well. So I know some of our traders got some really nice longs on the NASDAQ yesterday, trading in the morning session, and then continued that all day. We hardly saw a correction on the short term yesterday. It was an incredibly bullish day. I think the market, you know, you can see how the size of that candle, it's the biggest bull day we've seen in probably you know, a month and a half. So a massive move, and it looks like we've found some support into some resistance into an extension level. Looks like around that 12,200, very significant round number, but also a 100 extension point. So we could see the market stall around here, but once we get back above 12,200, I think we're going to be testing these highs. But once again, be very careful of the volatility. Watch for the Fangman earnings. They're coming out on the 20th of October. Netflix is the first one to look for. That will be, I think after that we've got Tesla, Microsoft and Tesla coming out on the 21st, and then we've got Amazon also coming out on the 22nd of October. So watch for those days, guys. We could see some potentially big moves in the market coming out of earnings. So keep an eye on those dates. I would put them in your trading journal and in your diary. Earnings season is coming out. So once again, very similar analysis to the S&P 500. However, the numbers are just different, really. I'd be looking for these support levels: 11,550 to 11,600, 11,200, and then 10,650. They're the key support levels to the downside. So if the S&P goes, the NASDAQ will follow as well. And then also too, that 10,650 is a very key level, because that means if that level breaks and the market holds below that level, that means it's a change in trend, a larger term trend, or the main trend on these larger charts, and that will mean that the market will be going into a corrective phase. And I think that's what we're going to see most of 2021. Will be mainly downside movement, but it will be quite choppy. The predominant trend will be grinding down to the downside. So guys, that's pretty much it in terms of wrapping up the analysis tonight. I just want to make mention for anyone who's new in the webinar tonight and would like to find out a little bit more about how you can learn how to day trade the markets that we do, our trading style. We have got a webinar on, it's actually every Wednesday night, which is actually on tomorrow night. It will be on the 27th as well, but it's on at 7 p.m. Australian Eastern Daylight Saving Time. So if you're in Sydney, it's at 7 o'clock. If you're in Queensland, it'll be starting at 6. And the topic will be how to learn to trade the future strategy. So we're going to be looking at these markets that Minah and myself showed you tonight, the S&P 500 and NASDAQ, as some of the major markets we trade, to show you how you can take advantage of these markets as a day trader. And then also I want to let you know that on the 27th of October, we have our next masterclass, which is Tuesday the 27th, and that will be with Ravi Pundit, who's an executive director in FX products for the Chicago Mercantile Exchange. And we're going to be talking about FX futures, which is the major currency pairs. So we're talking about the US versus the Aussie dollar, US versus the euro, US versus the yen, US versus the pound. So we're talking about the major Forex currencies that you can, or the major Forex pairs that you can trade. You can also trade that as a futures contract. So that's going to be a great presentation because the currencies are really starting to waken up at the moment. There's lots happening with the US dollar, lots happening with gold. So all that relationship all works beautifully well. So there's some great opportunities if you like currencies but want to trade through the regulation and the transparency of trading directly through one exchange, being the Chicago Mercantile Exchange. Yes, William, I'm in Queensland, so it's 6 p.m. Eastern Standard Time, but it'll be 7 o'clock Daylight Saving Time for tomorrow's webinar. And you can register for that webinar, at our website, which is idta.com.au. So you can go into the events page and book in for that. Now, I would love to open up the floor to any questions while we've got Minah with us, with a massive wealth of knowledge in the equity products. I've got a question here, Terry. What does the MYM and the M2K stand for? Not too sure whether you've got your answer. But the MYM is the micro Dow Jones, and the M2K Russell, or the RUT. Make it short. So guys, any questions? We're going to open up the floor to you. Okay, Paul's got one here. Can you please run through the NASDAQ levels a few minutes ago? Yeah, sure, absolutely. I'll just go, bear with me. So those NASDAQ levels, so 11,600, that becomes 11,600 to 11,550. That's basically the midpoint, right? Markets love returning back to midpoints because they're a point of balance. So that's the first level of support I've got there. So if we see the market turning down and we're looking for a potential target in the market, that would be a nice opportunity to see what happens to the market there. If the market stalls at that 11,600, and generally at these support levels, we'll see the market bounce off those levels. So that's why if you're shorting, you want to be out of the market and basically made your money, and you're sitting there waiting for the next opportunity or potential long off that 11,600 level. And this is the great thing about the indexes as well. If you're looking for support and resistance levels, the indexes love round numbers. You can see here 12,200 here was where the market stalled. It also did coincide with a Fibonacci extension level as well, a major fib level. I think it was like a 100% fib extension level, which is when you get that type of wave of quality, you start to see the market stalls as well, and the sellers start coming in. 11.2, why I came up with 11.2 is because it's a step break, plus it's the lowest point here. So when you draw a Fibonacci extension, I basically draw it from here, and then I pull back to that low point there, and then I let it run from there. So if that's 100% of the move of the wave, then that will be 100%, and that's a fairly common area of resistance, those 100% extensions. But to the downside here, this 11,200, if that market breaks that level, that's a well-known area. So it's a popular, going to be a popular support area. So when strong support areas get broken, then the market sees that and everyone goes in and starts shorting the market. So they're very strong psychological levels in the market. 10,650, upper level in the market because this is where the last very strong pullback was. And if you look at the weekly chart, we basically get 3 weeks. A famous trader called W.D. Gann, he loved looking at 3 candle charts. So if he saw you had 3 like daily candles or weekly candles in a row, or these larger charts, they provided a level of interest. So if the market breaks those levels, they become basically changes of trend. So if we break 10,650, that's a fairly strong sign that the trend has broken, particularly on the larger scale, like on a weekly chart. Maybe not so much on a 5-minute chart or a 60-minute chart, but on a larger scale chart, it's a change of trend. Hope that answered your question there, Paul. Frank.
Yep, I see that Frank asked, like, whether I said the ETH trading volume is about 30% of RTH for both ES and NQ. Good question. So I meant that, like, if you consider the daily trading volume as 100%, it's a 30% is more than 30% is ETH non-US hours, and probably 70%, less than 70% is trading during US hours for both the ES and NQ and MES and MNQ.
Yeah, it used to be when I first started trading indexes, it was about 20% in the ETH, but ETH is definitely growing.
Yeah, it's definitely growing. Yep. Yes, and Saud, to trade the futures, you need to deposit initial margin. That is the minimum requirement, but that's not for the intraday. But we would recommend you to consult with your broker.
That's right, and those numbers can vary depending on who you have a trading account with. That will vary. There's a question there, technical. Why do we love round numbers? Is it just an observation? Yeah, yeah, Kerry, that's a great question. They're just psychological levels in the market, and we see it happen all the time. The market just stalls. So if you're a day trader, we're always very mindful of those areas. If you're a longer term trader, it might not affect your strategy at all. But as a short term trader, we watch those levels because we see the market can stall. As you can see here, we had that 50% retracement level here at 11,550, but the market went all the way through that level and went back up to 11,600, and then the market stalled there for 2 days in a row, couldn't break that level, and then eventually it got through there on the 4th attempt. And then to the downside, you can see 11,200 acted as a fairly strong support base. So it was there for 1, 2, 3, 4, or basically almost a week. 11,200 formed the platform. So they're just psychological areas to look for, particularly with indexes. It happens a lot. The 3,500 was that magic figure that the S&P cracked early in the year, and then now we look like we're going to go and try and go to 3,600. That will be the next level. So they're just psychological achievements or milestones. Malcolm, yes, I don't. Has Minah got any different news than you? Not too sure. I don't think Minah, on her license, I don't think she can provide financial advice. She just can only represent the CME Group's products. Nick, are future profits taxable in Australia? If you're an Australian tax-paying citizen, we can't provide obviously taxation advice. It's not our level of our licensing. But what I do know is from my own experiences that being an Australian citizen, there is a tax treaty between the United States and Australia. So if you make profits or losses, you can claim tax either in one of the countries, whether it's the United States or Australia, you do have to declare that as income. So it's not like horse racing or things like that in Australia, which are tax exempt. This is these are trading profits, like stocks is capital earnings, and it has to be declared under taxation law. But once again, go and talk to a tax accountant. We do have accountants that do work with our traders, structuring them to be able to trade on the Chicago Mercantile Exchange, and also to be able to basically manage that, the money coming from overseas back into your account in Australia. So yeah, we can definitely assist you with that. So come to the webinar tomorrow, and you'll find out a little bit more about us. Is it Sword? What sort of capital do you need to trade? Well, you only really need to cover the margin requirements. So it really depends on, once again, the broker you go through or the clearinghouse you use. They will have their requirements. So our traders, a lot of our traders they can open up an account with $400 US, and they can trade a micro contract, an intraday trade. They won't be able to trade an overnight position, but they could intraday trade, which means you get in and out during the day with an account size of $400. However, there's a lot more risk implications involved. Before you actually start trading live money, you need to understand risk management and those types of things. So that's a bit more technical questions. Yeah, as long as you cover the margin requirement, and that can, as you found out today, that can vary from $50 to $13,000, depending on which market you're trading and what style of trading. If it's overnight positioning or if it's intraday, it can vary greatly. Great questions. Yeah, so the initial margins, Sword, that will vary. That will vary, but once again, it's an overnight position, so it will be more than an intraday position. That I think it's anywhere. I think some of our I think it might be anywhere from around about $500. I think for the micro contracts to have an overnight position. So that would mean you'd need to have at least excess of $500 plus what your if you're holding any losses, you'd need to be able to cover that to hold that amount to hold that trade. Otherwise, the exchange would just close you out of the trade. It's very important you always respect the margins. But I really love the idea of like some of the points that many of you raised about if you want exposure to these massive companies, these tech companies, which are enormous. It's a great way to position to get full exposure to all those strong companies in a very inexpensive way. So it's a really exciting product, and this is why our traders trade the micro contracts as well as the E-mini contracts so much now. They're taking off, and it just gives the trader so much flexibility, and you don't need a huge amount of money to trade these markets. So it's been a great idea by the exchange. It's something that we were waiting for, and when it came out, because we knew that there was obviously micro contracts like the micro gold and the likes and the micro currencies, but when the micro indexes came out, they were just taken up like immediately. Like you said, on the first day of trading, I think there was 300,000 contracts on the micro ES. So it's a really awesome product to be a part of, and we thank the CME so much for providing such a great platform. Johnson & Johnson earnings just came out now. Oh wow, positive. Okay, good one, Sword. You're on the ball. So it is reporting season. So this week there will be some information. So it's a great time to watch the markets. Great opportunities to day trade on these news announcements as well. Kerry, I'm assuming something like 5,000 in an account for a single contract. If you're trading the E-minis, you could, yeah, definitely, yeah, you would probably come within an industry standard risk profile of anywhere from around about 3%, 1 to 3% on an E-mini contract. On a micro contract, you could trade, up to 10 contracts on that amount of money, because it's a tenth of the size. So yeah, $5,000 is a nice little kitty. That's probably like most of our traders that I know, they probably start with around about $3,000 to $5,000 US in their account. Kerry, what is the best market for a beginner, and how much money should you plan on having in your account to trade responsibly? Like I said, you've got to make sure you be able to carry the margin. You just said 5,000. That seems to be, I think from experience, that seems to be a fairly common amount. It's from my understanding. But once again, it's trading is individual. You've got to understand the risk profile that you deal with. You've got to trade within a responsible risk profile. Anywhere from 1 to 3% is that. Some people do trade with a little bit more risk, but that's, once again, that's a personal choice. But definitely the index futures are awesome. The E-mini S&P, the E-mini NASDAQ. A lot of our traders don't trade the Dow Jones as much, or the Russell, but they're options as well. And then you've got the micro contracts as well, if you want to. The great thing with the micro contracts, particularly in really high volatile conditions, you can really dial down your risk. Rather than trading one contract on an E-mini, you could maybe go back and trade 2 contracts on a micro, or 5 contracts on a micro. Then you can basically cover that extra volatility by just making an adjustment to the number of contracts you're trading. Nick, would $1,000 be sufficient? Once again, if you can cover the margin, depending on who you're going through, yes, that would be fine. Once again, you've just got to be very careful of your risk. Some of our traders have traded with those types of accounts, trading with the micro contracts. That's where you'd be in that space. Too much risk to trade I think personally, it'd be too much risk to trade an E-mini contract. But the micro contracts, you could manage that. But once again, you'd have to, my preference would be to try to get a little bit more in your account, save up a little bit more before, but it's a good starting point. But once again, you don't need to start trading live account either. You can trade in simulation to start with first, learn how to do it, then you can go into the live markets. So we've never encouraged people to just start to learn to trade a futures contract and go straight into the live market. The great thing with all of the platforms around and the exchange is that they do provide simulation demo accounts. So you can actually trade simulation, and so it means there's no risk in the markets, and you can also trade replay data as well. There's a lot of the replay data we get from the exchange is saved, and we can practice in replay mode. So it's like replaying the match, watching it to see how what you could have done better. So that's always an idea for you to look at doing that to start with. But it's all about responsible risk management, and go slow to go fast when you're trading the futures markets. Kenneth, if you don't have a stop loss put in and the market crashes, will you need to pay back the leverage lost from your account? What is the loss more than the account balance? Kenneth, I'm not 100% sure. I've never been through that experience. I've never heard of that happening with any of our people that I know in our circles. So I'm not too sure. I don't know whether Minah could answer that question. I know you obviously the margin is obviously you lose that margin amount. That obviously acts as some sort of an insurance policy change, but I'm not too sure in that situation.
So like, in the exchange side, you saw that I actually presented two different margin levels called initial margin and maintenance margin. So initial margin is what is required when you actually first trade, you enter into the position. And the maintenance margin is the account balance that you have to maintain. So even though you didn't put any stop loss level, like let's say that after daily mark to market process, because futures settles every day, and if your margin balance actually hits the maintenance margin level, the broker will call you, because so that's called the margin call. So they actually ask you to top up the margin to the initial margin level.
But the great thing is there's even in a crash, there's always someone there to take the position, and that's what Minah was saying, that the market makers are always in place, because there's those liquidity providers that are in the market that are supporting and balancing the market out. So that liquidity pool is enormous. So that's always a great benefit. But you've just got to, like we say, there's trading does come with risks, and you just really need to be, not having a stop loss is a really rookie error when you're trading the futures markets, and you just don't do those types of things if you're a risk manager. And that's one thing that you always want to protect is your risk. Anyway, I think we're well over time. I've lost track of time here, but great questions, and thank you, Minah, so much for being a part of our program and our CME masterclasses. And make sure you come to our third one, because it's going to be awesome. It's going to be on the futures FX currencies, or the FX futures, which is another exciting product that the CME provides. So stay tuned to that one. It's on in 2 weeks' time, and hopefully we'll see some of you guys in our webinar tomorrow, teaching you how to trade these markets. And that's it from me. Thank you so much on behalf of IDTA. My name is Cameron Buchanan, and I'm signing out. And thank you, Minah, for joining us tonight.
Thank you for having me tonight. Thank you, Cam, and thank you, everyone.
Bye.